Here are 10 new California tax laws that could cost homeowners in 2026. Did you know nearly 40% of California homeowners could face higher taxes in 2026? And many do not even know it yet. With new laws rolling out this January, even middle-class families could see sudden tax hikes, property reassessments, or worse, risk losing their homes. And no, this is not just about luxury mansions or investment properties. These changes hit regular people in regular neighborhoods harder than ever before. If you think you are safe just because you have owned your home for years or inherited it from family, think again. Several new laws have quietly slipped through the cracks. Laws that target everything from inherited homes to rental properties, even homes that have not changed hands in decades. The scariest part is that most of these changes come with little warning until the tax bill shows up at your door. In this discussion, we are breaking down the 10 new California tax laws you need to know in 2026 and how they could cost you more than just money. Stay with us because the last one might be the biggest financial trap yet. Law 1, the return of the mansion tax affects more than mansions. You might think a mansion tax only applies to the ultra-wealthy living in Beverly Hills mansions or beachfront Malibu estates. But as of January 2026, California's updated version of this tax is hitting much closer to home, literally. Under the new rule, any property sold for over $2 million in certain counties like Los Angeles, San Francisco, and Santa Clara is now subject to an additional transfer tax, often ranging between 4% to 5.5%. That might not sound like much until you realize that amounts to $80,000 to $110,000 on a $2 million sale. And with inflated property values across much of California, even average-sized homes in formerly modest neighborhoods are crossing that threshold. Here is the catch. It does not matter if you are downsizing, retiring, or just moving away. If your home is worth over $2 million, even if it looks nothing like a mansion, you will be paying this extra tax unless you qualify for a rare exemption. And unfortunately, those exemptions are hard to get. So what can you do? First, check your latest appraisal or market value estimate. You might be closer to the $2 million mark than you think. Second, consult a real estate tax professional before listing your property. In some cases, the timing of the sale or how the property is structured, like under an LLC, could help you minimize the financial hit. Bottom line, the mansion tax is back. But now, it is not just targeting the rich, it is targeting everyday homeowners. Law 2, Prop 13 protection has weakened for inherited homes. For decades, Prop 13 was seen as the ultimate safety net for California homeowners. It kept property taxes low and predictable, especially for families who plan to pass their homes down to their children. But starting in January 2026, the protection has quietly weakened, and many families will not realize it until it is too late. Here is what changed. Under updated enforcement rules tied to earlier reforms, inherited properties are now far more likely to be reassessed at full market value unless very strict conditions are met. That means if you inherit a home that was taxed based on 1980s or 1990s values, the county can suddenly reset the tax bill to today's sky-high prices. We are talking about property taxes jumping 2 times, 3 times, or even 5 times overnight. Imagine inheriting your parents' home, feeling grateful and secure, only to receive a tax bill so high that keeping the house becomes impossible. This is already happening across California, especially in high-value areas where home prices have exploded. The law does not care if you grew up in that house. It does not care if it is your primary residence. Now, if the paperwork is not perfect, the reassessment kicks in automatically. So what can you do? First, understand that doing nothing is the most dangerous option. Families need to plan before a transfer happens, not after. Setting up proper trusts, filing the correct homeowner residency forms on time, and knowing the reassessment rules can make the difference between keeping the home or being forced to sell it. The hard truth is this. Prop 13 still exists, but it no longer guarantees protection. And for inherited homes in 2026, ignorance can be incredibly expensive. Law 3, capital gains taxes just got costlier for home sales. If you are thinking about selling your home in California this year, pay close attention. As of January 2026, a new set of adjustments to capital gains taxes could eat away a huge chunk of your profit, especially if you have owned your home for a long time. Here is what is happening. California has introduced a higher capital gains tax rate for real estate profits above a certain threshold, typically $500,000 for individuals and $1 million for couples. Sounds like a lot. Not really when you consider how much home values have soared in the last 2 decades. A modest home bought for $400,000 20 years ago could now be worth $1.5 million or more. That means your gain might be over $1 million. And that extra money is now subject to a state-level tax rate of up to 13% on top of federal taxes. That could mean tens or even hundreds of thousands of dollars gone just like that. And here is the kicker. Many homeowners do not realize this until after the sale. They see a big closing check and think they have hit the jackpot until tax season rolls around and the IRS and the state of California come knocking. But you do have options. Tax strategies like installment sales, 1031 exchanges, or even charitable remainder trusts can help reduce your capital gains exposure. These are not loopholes. They are completely legal tools that many investors and wealthy homeowners have used for years. So do not wait until escrow closes to think about taxes. Talk to a tax advisor before you list your home because in 2026, the cost of selling in California could be far higher than you ever imagined. Law 4, rent control has tightened, even for small landlords. If you own a duplex, triplex, or even a single-family home that you rent out in California, you might think you are safe from rent control laws. But starting in January 2026, new expansions to statewide rent control mean that even small landlords are now being pulled into the system, and many do not realize it until they have broken the law. Under the latest updates to AB 1482, the rent cap of around 5% plus inflation now applies to more property types, including previously exempt units like newer buildings or single-family homes held in family trusts or LLCs. What is worse, more cities are layering on local rent control ordinances, some even stricter than the state's rules. That means your ability to raise rent is now limited, not just by state laws, but by whatever city or county your property happens to be in. The result is that many landlords are seeing their cash flow shrink while their expenses, insurance, taxes, and maintenance, continue rising. In some cases, it is becoming harder to cover the mortgage, let alone turn a profit. And if you try to raise rent above the legal cap, you could face lawsuits, fines, or forced rollbacks. So what can you do? First, do not assume you are exempt. Check both state and local ordinances to understand exactly what rules apply to your rental. Second, consider long-term leases or tenant agreements that include built-in increases within legal limits. And finally, get professional legal advice before making major decisions like evictions or rent hikes. The bottom line is that rent control in California is no longer just a big city issue. In 2026, it is on your doorstep, and ignoring it could cost you far more than you think. Law 5, the new wealth tax could target your home equity. Think wealth taxes are only for billionaires? Think again. As of January 2026, California has officially enacted a state-level wealth tax, and it is not just targeting the ultra-rich. If you own multiple properties or have significant home equity, your finances could be in the crosshairs, even if your income is modest. Here is how it works. The new law allows California to assess a yearly tax on total net worth, not just your income. That includes the value of your real estate, investments, and even some business assets. If your total assets exceed $25 million or $50 million for couples, you could be subject to an annual wealth tax of up to 1%. While that threshold might sound high, it is closer than you think, especially for property owners in expensive counties like Santa Clara, Marin, or Orange. Let's break that down. If you own a primary home and two rentals, each now worth over $2 million, you might find yourself nearing that wealth tax threshold, even if you do not feel rich. And with California's soaring property values, more middle-class homeowners are being swept into this tax bracket every year. What is worse, the law includes provisions that allow the Franchise Tax Board to estimate your assets even if you have not sold anything. That means your wealth tax could be based on paper value, not actual cash flow. The takeaway is simple. Do not ignore this. Work with a financial advisor or tax strategist to understand where your net worth stands and what legal protections or restructuring options might be available, like setting up trusts or reallocating assets. The wealth tax may have been designed for millionaires, but right now it is dangerously close to impacting ordinary homeowners across California. Law 6. The exit tax could follow you out of California. If you are planning to sell your home and move out of California in search of lower taxes and a simpler life, think twice. As of January 2026, a controversial new policy known as the exit tax is making it harder and more expensive to leave the Golden State behind. This new law allows California to tax former residents on certain assets and income even after they have relocated to another state. The main targets are high net worth individuals, business owners, and long-time property owners cashing out on appreciated real estate. If you sell your California home for a significant gain and then move to a no-income tax state like Texas or Florida, the state may still tax your capital gains or other residual income for several years after you leave. Even if you are no longer living in California, the Franchise Tax Board can claim that you still owe state taxes, especially if you maintain any business ties, rental properties, or financial interests within the state. And yes, they have the legal authority to audit and pursue those taxes across state lines. So what can you do if you are planning an exit? First, do not make any sudden moves. Talk to a CPA or tax attorney who specializes in multi-state planning. You may need to sever financial and residential ties carefully over time to avoid triggering audits or unnecessary taxes. Selling assets, changing business structures, and officially establishing residency elsewhere all require a paper trail. The dream of escaping California's high tax burden is still possible, but in 2026, the state is doing everything it can to hold on to your money even after you are gone. And if you are not prepared, this goodbye could cost you dearly. Law 7. Hidden transfer taxes are eating into sale profits. Selling a home in California used to be relatively straightforward, but in 2026, that process has become more expensive than ever, thanks to a quiet rise in local transfer taxes that are hitting sellers where it hurts, their final profit. While the statewide base transfer tax remains the same, many cities and counties have now added their own layers of real estate transfer fees, particularly in urban and high-growth areas. In places like San Francisco, Oakland, Santa Monica, and Pasadena, the total transfer tax can now reach $15 to $25 per $1,000 of a property sale price. That means on a $1.5 million home, you could be paying an additional $22,500 to $37,500 just to sell. The real kicker is that many sellers do not know these taxes exist until escrow is about to close. And by then, it is too late to renegotiate or plan around it. These fees are often buried in a fine print and can be imposed regardless of whether the sale is a downsize, inheritance, or even a divorce-related transaction. If you are selling in 2026, you need to be proactive. Start by researching your local jurisdiction's transfer tax policies, and do not assume they are the same as last year. Even within the same county, different cities can have vastly different rules. It is also wise to consult with a real estate attorney or closing agent before listing your property. They will help you calculate the true cost of the sale. In a market where every dollar counts, these hidden taxes can wipe out tens of thousands from your net proceeds. So before you celebrate your sale, make sure transfer taxes are not quietly draining your equity behind the scenes. Law 8. Green energy mandates now require costly upgrades. Thinking of selling your home or refinancing your mortgage in 2026? Be prepared to go green or face some serious financial penalties. California's new energy efficiency mandates are no longer just recommendations. They are requirements, and they could hit your wallet hard if you are not ready. Under updated environmental codes, certain homes now must meet minimum green energy standards before they can be sold or refinanced. That means you may be required to install solar panels, upgrade to energy-efficient windows, replace outdated HVAC systems, or even insulate older homes to meet new benchmarks. And these are not optional anymore. Non-compliance can delay closings, reduce appraisal values, or trigger added taxes and fees. The goal is admirable. Reduce California's carbon footprint and move toward a more sustainable future. But the costs fall directly on homeowners, many of whom were not budgeting for $10,000 to $30,000 in upgrades just to close a deal or refinance. Here is the surprising part. Even modest homes in older neighborhoods can be flagged under these new rules. You could be forced to upgrade simply because your house has not had energy improvements in decades. And if you are trying to pull equity out of your home or downsize in retirement, these mandates could erase a huge chunk of your proceeds. So what is the move? First, check your property's current energy efficiency rating if available. Second, explore state or local rebate programs. Some offer partial refunds or tax credits to offset costs. And finally, work with a real estate agent or loan officer who understands how to navigate these green requirements. In 2026, going green is not just about saving the planet. It is also about saving your sale. Do not let energy mandates catch you off guard when it matters most. Law 9, gentrification is driving up property taxes for longtime residents. If you have owned your home for years in a once quiet neighborhood that is now up and coming, you might be sitting on a financial time bomb, and not in a good way. In 2026, California counties are ramping up property reassessments in gentrifying areas. And that means your property taxes could skyrocket, even if you have not made a single upgrade to your home. Here is what is happening. As investors and developers pour into lower-income or working-class neighborhoods, property values rise, and county assessors take notice. Homes that were once valued at $300,000 or $400,000 are now appraising at over $1 million, even if they have not been renovated. The result is that longtime residents, especially seniors or low to middle-income families, are seeing massive increases in their annual property tax bills. In many cases, these hikes are based purely on market trends, not actual improvements. That means you could be penalized just because your neighborhood is suddenly considered hot. And if you are already living on a fixed income, these surprise tax increases can be devastating, sometimes forcing families to sell their homes just to keep up. What can you do? First, do not wait for the bill to show up. Monitor your county assessor's reports regularly. If you notice a sharp jump, consider filing for a property tax reassessment appeal, especially if comparable homes in the area have not sold at inflated prices. You can also look into California's property tax postponement program, which allows eligible seniors, blind, or disabled homeowners to delay payment. Gentrification may look like progress, but for many longtime Californians, it is becoming a slow-motion eviction delivered through the mailbox, one tax bill at a time.